I want to give you two ways to access the equity in your home for the purpose of purchasing your next home without selling your current home. There's two good ways to do this, among other options, but these are two options that you may be considering. One would be, if you have not listed your home yet, you can apply for a home equity line of credit that will sit there and be ready for you when you then go and put an offer on a house. This is something that you can open up as a line of credit and not draw on the balance until you need it. So if you don't have a balance on that home equity line of credit, you wouldn't have any payments. So that is one thing that's very attractive to a lot of homeowners looking to purchase. This is probably the least expensive option of the two that I'm going to talk about, but you can only do this if you have not listed your house yet. Once you've listed your home, you can't access a home equity line of credit. These generally will allow you to borrow up to a total of 80% of the value of your house. And the total is calculated by taking your first mortgage plus your new equity line, adding them together, and as long as the total of those two is no more than 80%, then that generally works. Some banks and credit unions have slightly different total amounts that you can do. I have seen 85%, I've seen 90%, but be very careful, because you want to make sure that when you do sell your house that you will get enough from the sale to cover paying off both of those mortgages that you've used. A home equity line of credit is actually considered a mortgage, a second mortgage, because it's a lien, and a mortgage is a lien. So the other option that you can do, and this would be in the case that you have already listed your house and you can't access a line of credit. A bridge loan would be something that you could look into, and we have bridge loans, and they will go to 85% of the value of your house, and it's calculated the same way. It's at 85%, which would be the total of the loan amount for the first mortgage that is eventually getting paid off when you sell, and the bridge loan that is put into place. So that means that if those numbers stayed, 100% of the sale of your house would go towards paying the selling costs, paying off the bridge loan, and paying off your first mortgage and any other fees or anything that's generated from that sale. When you sell your house, everything is paid off, so then you'll be left with just the mortgage on the purchase of the home that you just did. Most of the time, you then would also have more money than just from the sale, from just paying off the liens of the first mortgage, the bridge loan, and any other costs associated with selling your house. You could take that amount and put it towards your new loan on your new home, and as long as that amount is $10,000 or more, you generally can do a recast and recalculate the monthly payment based on the new lower balance that you just paid down. But this is not available with all mortgage companies, so if this is something you're interested in, please make sure you ask your loan officer. We do recast at CrossCountry Mortgage, so this would be something that we would talk about. So if you have any questions on this, or want me to look at your scenario, please reach out.